Hi, thanks for tuning in to 21st Century Income. Today I'd like to speak about the falling dollar and the possible coming revaluation of the Chinese currency called the yuan. And let's talk about those as they relate to generating income. So if you are at retirement age and you've built up a sum of money and you're now going to try to turn that money into income, how does that affect you? We have the dollar falling in international markets, and it's falling in international markets because of many complex reasons, but at least the closest cause is a lot of what's going on with subprime mortgages and financial issues in the U.S. That has caused the Federal Reserve to make its first interest rate cut last month. And the consensus is that the Federal Reserve will have to continue to cut rates to assist the economy in healing with all the various mortgage issues. That, of course, does not bode well for the value of the dollar internationally, and that's why the dollar is falling. Now, when the Federal Reserve cuts rates, it affects the most. Let's talk about income. If you're, again, at retirement age or you're into retirement and you're generating income, when the Fed cuts rates, most people are savers, and most savers live on what's called the short end of the yield curve. For us, that means money markets, CDs, checking accounts, things like that, bonds. Those instruments are most affected when the Federal Reserve cuts rates. And the effect of that is that going forward, you will earn less interest income. Now, the falling dollar also in international markets has other implications, one of which is that China, who we import a large amount of goods from, China may be revaluing their currency upwards to the United States. And what that means, of course, is that those imported goods will now become more expensive. And you can see imported goods becoming more expensive in things like oil that have gone up simply because we import so much oil. As the dollar goes down, the people who export the oil have to be paid more just so that they can be paid the same. So you have these twin jaws: lower interest income, higher inflation. And it is effectively a war on savers. Again, savers being people who live in savings accounts, CDs, checking accounts, short-term bonds. So in the 21st century, or generating 21st century income, what it's going to be about is how do you profit from these? How do you make profit from these changes? These are major structural changes that are going on both inside and outside of the United States. And our job as people who generate income in the 21st century is to make a profit from that. And generating this income, I think, in the future is going to be less about how much you have and more about how you actually manage it. Because in the old days, you could have a certain amount of money. You used to be able to go to the bank and maybe make 8 or 9% on that money, or there was a time even 10%, and not take any risk. So now, of course, that's not the case. You can't make that. You can only make maybe 3 or 4%, and going down. And inflation is going up, which means that the amount of goods and services that money buys is getting less. It's becoming less. So the challenge is going to be to take those old rules, things like rules about risk, rules about time horizons, rules about how do you properly manage an account, or how do you manage your money for income. Many of those old rules don't apply anymore, and in fact are dangerous if followed. Kind of like there was a time when people thought the earth was flat. Well, now we know that it's not flat. So what I'm saying is, in the 21st century, it will be more important about how you manage the money you have for income. How do you generate that income than about exactly how much you have. Thank you for tuning in.